So-called bear market and long-short mutual funds are intended to mimic the performance of hedge funds. They're becoming popular, very popular, among PIMCO and JPMorgan Chase investors. Jed Laskowitz is head of global strategic relationships for JPMorgan's fund unit, and he joins me here on set. Jed, good to see you. Thank you so much for coming in.
Thanks for having me.
Explain this. This is a little complicated. What are we looking at here?
It is. Market neutral bear market funds. It's a fairly sizable category. And in 2008, as the financial crisis unfolded, everything became correlated. These types of strategies were one of the few safe havens for individual investors.
Why is that?
Well, it is important to distinguish between different types of bear market funds. That tends to be a catch-all category. There are funds that try to take zero market exposure, like market neutral funds. There are market neutral funds. There are long-short funds that take some directional bet in the market. And there are funds like 130/30 funds or large extension funds that take a directional bet. So it's a category that investors really need to talk to their financial advisor about before investing in.
Talk to us about timing. How critical is timing in something like this?
Well, it's a good question, and I think one thing we learned in 2008 is that you really can't time the market. So having a permanent allocation to asset classes and strategies that offer a buffer to volatility, low correlation, things that aren't going to move with the direction of markets is important. So clients that were positioned here in 2008 when the crisis unfolded were obviously very pleased with their allocation. Obviously, over time, that may change. They may increase the allocation in times of stress or decrease it in times like we've seen since March as equities have come back. But we think it's important for clients to always be invested there.
And also important for clients to understand that one size doesn't necessarily fit all, does it?
It's extremely important because there are a number of different ways to achieve a similar result. Just at JPMorgan alone, we have 3 different market neutral funds that really try to achieve the same objective: positive returns in market environments regardless of market direction. But 2 take a more quantitative approach, 1 takes a more fundamental approach. So it's important to understand what you're investing in.